Hello, it is the 27th of February 2011, and today I want to go back in time and take a look at what silver looked like 20 years ago. And it was in a extreme downtrending position. $361 for 100 ounces. That's $3 and 2/5 for an ounce of silver. Those prices well behind us. This pretty much was the bottom, but it's interesting how many people didn't flock into silver at this time. You'd think if the prices were the cheapest, more people would want to buy. But nope, not many flocked in as the market was in the process of bottoming. But at this point, you wouldn't be saying, looking at the charts, yep, this is it's done. It's done to the downside. We're finished. You really couldn't see this here. Now, there becomes time frames when you can state to yourself, well, when something goes down too much, it really is too much. Now, not on every occasion, but one would maybe look at how much it costs to mine the metal and so many other different particulars for its given time frame. Inflation, of course, being the biggest. Now, over the 5 year period, silver was just getting hammered. 17-year lows. It's dark times for the silver market. Very, very dark times. This 2 year moving average, or 1 year moving average, so declining. Such a miserable, miserable market. But sometimes when they're down this much, it can be a good thing. Of course, not many decided to get into it. On a 10-year chart with a 2 year moving average, the market's just heading lower. But what was a little concerning was this break of this trend at around $5 an ounce, which was support, and support really getting hammered there. Not much optimism for silver here. Now, long term, it's this is what we see. We see a peak low or a low and a high. Now, whenever in any chart on any time frame you have a big move either up or you have a big move lower, and then you rally from that period or you move in the opposite direction, then you're either going to have to break it to the upside or to the downside. If you fail to do so, you will be faced with wedge patterns and so many of these other things alike, and it really has to break through to one side or the other. So when you get in the middle, you got to say to yourself, okay, where's it going to break to? It's either going to break below here. This is $1.25 an ounce, or break above this level, which is $50 an ounce. Now, as of today, 20 years after this chart, it still hasn't decided if it's going to break below this low or break above this high. And back in 1991, this Fibonacci data was as easily calculatable, I guess, as it is today. And these would be the significant levels to look out for. So 299 would have been the key support. Now it looks like it's breaking below the 512, which was that big level. So what you're looking for is you're looking for confirmation below. That hasn't happened yet. Just because you go below a line like you see in here, that's not confirmation by any means. What you would have needed was to see it range for a bit, then fall, or combat the resistance and then continue its weakness and really confirm a move down at least to this $3 level. And that did not happen. Now, obviously, if it breaks below this level and it becomes that of a trap, then usually a fast move would happen in the other direction. Now, it took a while for that fast move to happen, but it sure as heck did go through. The 61.8, 12.22, that's $12.22 an ounce for silver. That's what it would need to get above to state it looks very bullish. And if we can confirm that this will break out above 1222, then we're most likely going to reach the 50 target. Now, when we've seen a break to this level here in 2008 to 2135, which is pretty much exactly at that level, and then we've seen it in 2008 come back to $9, but really with it shaking, you can almost say it was back to this level, and then higher again. That's really confirmation again that we have successfully confirmed a breakout of this level here, where we failed to successfully confirm a breakdown of this level of 5.12 or $5.12 an ounce. But we're going to have to break this range to one side or the other, which means either we break above 50 or we break below $1.25. If we break below to the downside, we're going to 78 cents. Below that is 49, and below that is 30. That's where we're heading towards on a break on the lower end of the scale. If we break above it, our first target on the upside is 80, followed by 129, followed by 208. That would be the next upside targets. So to me, back at this time frame, I guess if you use common sense in stating, well, if an inflationary level we go down to this anywhere below here, that it becomes the greatest buying opportunity in the world. Because it shouldn't be this low. Question is, were people saying that back in here? If it goes below here, it's the greatest buying opportunity. If they did, well, at that point, they would be correct. Thank you for watching this video, and have yourself a great day. Bye-bye.